In 2013, Rwanda issued a $400 million Eurobond that pulled in a 6.6 coupon rate. This has been cleared partly with the help of the 10-year 2021 issue amounting to $620 in a debt sustainability program. The initiative focused on funding infrastructure projects like international airports and expansion of the country's road network. Ultimately, this has boosted Rwanda's economy, attracting trade and foreign direct investment. Ghana, Kenya, Senegal, Benin, among other sub-Saharan countries, have utilized the international debt instrument, as the case with South Africa. In contrast, Uganda hasn't embraced the financing model, as experts such as Alan Retaba pointed out the need to prioritize domestic investment. This is, however, part of the many challenges, including the fragile local currencies, which can favorably compete against currencies such as the euro or dollar during times of repayment.
How much money will you make if you invested in a Eurobond or a bond in the overseas versus making money in Uganda? If you're investing in Uganda for 20 years, for example, government is able to pay you up to 16% every year for 20 years. Yet if you are to invest in London or the US for a Eurobond, for example, you only earn about 5% for 20 years every year. So it may not make sense for someone who is in Uganda to buy a bond outside, yet you could make more money by buying a bond from government of Uganda. So this may be one of the reasons that why we are not seeing more people investing outside Uganda, and we are seeing more fund managers, NSSF, insurance companies and banks concentrating on buying the bonds of government of Uganda, because they offer better money, it's a lot easier, it's a lot cheaper, it's more efficient. So those may be the reasons why you see more people concentrating in Uganda.
Debt sustainability has attracted the growing uptake of the Eurobond in Sub-Saharan Africa. Meanwhile, as interest rates hike, including the Federal Reserve's that has raised the key lending rate to 5.25%, the highest in 16 years, there is growing fear over capital flight, more so in emerging economies. As such, Eurobonds are anticipated to yield better with low subscription and bond prices.